So most of you know me. I'm Cassie Viella. I'm a property manager and a realtor here in San Antonio. We do some investing as well. I thought, with everything going on right now, um, there's a lot of speculation. There's a lot of fear. Um, Nobody knows what's going to happen. But in my mind, just having the most up-to-date data is important for investors to kind of make decisions going forward. So we're just going to kind of talk about what's going on and what has happened in the market so far. And then we can kind of have questions or some networking time. So I'm going to talk really briefly about events because everybody knows what's going on. I don't think you need an update on COVID-19 really, but and then we'll get to the data quickly. So I put some links in here though, just in case you want to see where this data is coming from. I was really surprised that in March, the unemployment stayed at 4.2 in San Antonio. Although that it just started happening in March. So I think definitely in April that'll go up. And then also, it's kind of worrisome that 13% of our jobs are in hospitality. So, if all of that is closed down for the foreseeable future, that can have a pretty negative impact on the city. But luckily we still have a pretty healthy healthcare sector and other sectors. So I don't think we'll be as hard hit as some other areas. Yesterday was a really fun day because my husband's a petroleum engineer and he was flipping out all day along with everybody he knows and answering phone calls and texting. And so yeah, this oil price drop is definitely going to have ripple effects across everything. But it's as far as sometimes I have people ask because we have the Eagle Ford Shale south of San Antonio, and there is some oil field activity. This layoff at Halliburton, they basically kind of closed down their Elmendorf office, but that's still a relatively small amount of people. So it's not that necessarily. It's going to be the bigger effect that it's going to have on the stock market, and so of course it's going to affect the stock market. Real estate isn't always exactly in line with the stock market. There have been recessions where real estate actually does better and goes up. But in this one, I think that it definitely is going to be affected because, as we'll talk about at the end, lending is going to be a problem. So here's just some data. Here's the showings per week. So you can see the week 1, week 2, this is March here, and then we started in April. And I was really interested today when I was pulling this, it was going down and then now it's starting to come back up. And so, that's showing me that the people who need to buy a house are going out and looking and they're going to buy a house. There might have been a couple of weeks pause where everybody kind of froze, but people are getting back out there and looking. But I mean, obviously this number should be over 6,000 because there should definitely be more showings in April than March. So here's a chart of homes for sale. That's March of last year. You can see how last year, our market should start to go up as spring approaches, right? After January, February, there should be an uptick. And so it's worrisome to me that it's going down. There are less houses listed. This downward trend is concerning to me. But it's not, they're still about the same as there were last year. So it's not as though it's completely crashed already and they're, everybody's freaking out. People are still listing their homes. It's just slowed down a little bit. And all of this data is limited to just homes that are 100 to 200,000 because as investors, that's pretty much our wheelhouse. And then I just in San Antonio. So there's, it's just focused on what we need to know. And then pending sales. So this is how many houses are under contract on the market. So you can see we're under where we were last year. it was on an upward trajectory. And what I saw was a lot of back on markets. So a lot of people backed out of contracts that they had in March when all of this COVID started. So I think that's why there are less under contract at the moment. I don't know if that will rise as people kind of get used to the new normal, or it'll continue to drop. In a couple of weeks, we'll have April's data, and that'll tell us a lot. Here are new listings. So this actually shows me that people are still putting their house on the market. They're still ready to move. You know, it hasn't ground to a halt. You're higher than February. You're about where you were last year. So people are expecting to sell their homes. And then here's sales price. This isn't going to start going down for a while. Usually price drops follow by several months slowdown. It takes everybody a while to convince their clients that their house isn't going to sell for as much as they thought it was. So that takes a couple of months, and you know, homes have to sit around for a while for that to happen. So this probably, you know, you're not going to see a drastic decline for a little bit. And then this is just right now what's on the market. So you can see 308 new listings, lots of price changes. So I'm seeing, you know, I log into the MLS every morning and look at the new listings and price changes, and I'm noticing that there are fewer on the market right now. There are fewer new listings, fewer price changes each day than there were, but not drastically again. And you see here, active option means under contract. So the fact that there are 519, business is still being done, people are still buying homes, like it's still happening. So, okay, lending is the main concern right now. So I've spoken to my mortgage broker and to my commercial lender this week, and both of them are freaking out. The CARES Act, and I didn't even know this because I just don't watch the news because it's too depressing. But the CARES Act, it allows people to just claim forbearance on their mortgage. They don't have to prove a reason. They don't have to show a job loss or any hardship whatsoever. They can just call their company and say, I don't want to pay my mortgage. And the mortgage company has to do that. And so you can imagine how that's going to affect lending overall. You know, if every American takes advantage of the fact that they don't have to make a payment for a year, or even a good chunk of Americans do that, lending is going to be in a bad place. You're going to have liquidity crisis. They're not going to be wanting to lend. So the numbers on this so far are that 5.5% of mortgages have already asked for forbearance. So it's a significant amount of people that are already claiming this, and I suspect that as more people find out, that'll grow. And so the important people to think about here are the mortgage servicers. So this is who you pay your mortgage payment to. They turn around and sell your mortgage on the secondary market, right? And so they sell it to Fannie Mae, Freddie Mac usually. They still have to pay those lenders. They still have to pay Fannie Mae, Freddie Mac over the secondary market, even if you don't. So that mortgage servicer is really feeling the pinch right now because they're having to pay out $3.4 billion a month right now. That's going to grow as more people take forbearance. So they are their money is running out. The CARES Act did not give them any relief programs. It did not contain anything that helps mortgage providers. So it just sort of enforced this hardship on them without giving them anything to help them get through it. So it's kind of terrible. So you can kind of see, even if just a quarter of Americans that can apply for this, $75 billion per month. And that's just going to collapse so many companies. And so what does that mean for us as investors? That just means that lenders are not lending as much as they were. So they're being so much stricter. My mortgage broker was telling me she gets, you know, several emails a day that are like the updates for the requirements now. It's changing constantly. So some of the things are your credit score is going to have to be higher. She said 700 or higher is kind of going to be the new normal. You're going to have more money in the bank. So a lot of you know that if you buy a investment property with a mortgage, you have to have 6 months of mortgage payments for all of your properties in the bank, right? You have to be able to show that you've got that cash available. So that's going to, she says, go to 12 months. You're going to have a whole year's worth of payments. Well, obviously, because, you know, they're worried about this forbearance thing. They're worried about, you know, tenants can't be evicted at this point. So you're asking for a loan to buy a rental property. So it's just extremely risky for them. So they're just upping all of the requirements. If you are self-employed, it's going to become, she said, almost impossible. She's a little dramatic sometimes, but you know, it's going to be really hard for self-employed individuals to qualify now, harder than it was. It was already hard. It's going to get harder. And then higher down payments. So that's just, you know, it's going to get harder to get a loan. It doesn't mean you can't. It just means it's going to get more difficult. Commercial lending is kind of in the same boat. My commercial lender, you know, was telling me that they have a lot of forbearance that they're granting to, you know, strip centers and all of the commercial real estate that has just been killed by this. So whether, you know, any way you're going with a loan, you want to check in with them. If you have been working with somebody in the past and you haven't spoken to them in a couple of weeks, you might want to check in, make sure you're still good to go. And I know that a lot of the hard money lenders are just gone. We could talk about that later, but you know, I've heard that that's going to be pretty hard to find as well. And so the interest rates here, it's kind of confusing because if you go online and you Google mortgage interest rates, you're going to see like 2.75 and these awesome numbers. You'd be like, awesome, I can get this great loan. Well, that's what the base number is at, but because of the high risk, most of the lenders who would actually make you those loans are demanding a higher interest rate. So just because there's a possibility for it to be 2.75 doesn't mean that's going to happen. And there, she said there still are some companies that are doing pretty low rates, but most of them have raised their rates, especially because there was a flood of refinances a couple of weeks ago. And so as they ran out of capital, they raised rates to, you know, discourage people from refinancing basically because they couldn't handle it anymore. So just, you can kind of see how all of the things going on, it's just become extremely risky for lenders, and you're going to have to prove that you are a solid bet for them, that your property is a solid bet, and just really, you know, cross every T and dot every I. Now you're really going to have to pay attention to that.